Good morning, everybody. Steve and Levi here again. We're talking about more properties and we're shifting over into Birmingham, which is a market that we really love if you're looking for affordability and good old boring cash flow. Birmingham is one of the best markets for that. I've helped clients get into lots of properties in Birmingham over the years. So this one has a little bit of an interesting background as it was brought to us. So we build new construction in Birmingham, right? And we handle with our own in-house GC all of that work. But also for our Concierge BRRRR program, we've got a contractor that we work with to renovate those homes. We don't want to mix the new builds with the renovation on the older homes. And our general contractor on this brought a few properties that he's willing to offer. They've been renovated in the last 2 to 3 years. And the cap rates for a, recently renovated home with a tenant in place, they're really good. They're really good, and it's a low cost. So we wanted to feature a couple of those and make sure that you understood them today. And of course, you have the right to get an inspection. You absolutely should. So Levi, let's get into this one. It's a bit of a mouthful for the address. I'm going to try.
Say the address.
116 16th Court Circle, Northeast. I think I said it. So somebody dreamed that up. So this is in a neighborhood that we really like for BRRRR or for low-cost rental properties called Center Point, north of downtown. And you're dealing with homes built anywhere from the 50s through maybe the 80s, right? And these are properties that are in an established area that do have retail value. One of the dangers in getting deep into the BRRRR model, which this one isn't, because it's already been renovated, is you have to find that middle ground between being in a neighborhood where you can get appraisals, where people actually will get loans and pay to live in homes, which in some C&D areas doesn't happen, but you can't be in so nice of an area that you can't find any distressed deals, right? And so these are in a neighborhood where we find those typically, but this is not a distressed deal. This is just a layup or a free throw, an easy deal for somebody. Yeah, exactly right. So we've got the pro forma up on the screen, and you can see we've got a purchase price of only $110,000. I haven't seen a number like that in a long time. Yeah, so let's get into the nitty gritty on this thing. We've got, you see it in front of you, Levi. Walk us through some of the down payment, the values. What are you seeing?
You're right. It's completely amazing to see, something that has this kind of top number in terms of purchase price. But you're only bringing in, total cash needed, including down payment and closing costs, just over $25,000. So, 25.3 to get you into the thing. We're running a cap rate at, in the sevens, which is impressive.
High sevens.
It's just high 7.9.
Yeah.
So it's nice cash flow at, $197 out of the gate.
Yeah.
Where can you invest that kind of low down payment and closing costs, low entry costs, and get that kind of return? And what we've been looking at a lot lately is not just what month one looks like, but push it down the line. So why don't you talk a little bit about kind of what it looks like in a medium hold kind of situation?
Yeah. And I'll set the table on that. I think a couple things worth mentioning to preface it is we are doing the forward commitment on this if you pre-qualify with our lender. So you're going to get a 6% interest rate locked. I think that rate would be closer to 7 if you were refinancing today. So you can bring more cash to the table to buy that down further if you want to, but it works. It works without that. When the cap rate is 7.9, right, and the interest rate is 6, I don't mean to oversimplify it, but you've got positive leverage there, so you're going to get a return on your cash. Because what a lot of investors think about right now is they can buy treasury bonds and earn a nice, steady, predictable return on their money. So there has to be that risk premium above and beyond what they can earn in that market. And I really think that's here on this one. We're renting it for $1,100 a month. And when I say we're renting it, I'm not saying we're going to. There's somebody in there right now paying $1,100 a month. And as a part of your due diligence, you can get copies of the leases. We can talk with management and answer your questions. And as I said previously, you can certainly get the appraisal. You can and should, and your lender will require it. But also, let's get a home inspection. Even though it was renovated 2 to 3 years ago, the responsible, prudent thing to do is to make sure that the property is good to go and isn't going to give you any big problems in the near future. So you're going to have a positive cash flow of $200 a month on the property. And as I get down into the returns, we're focusing on return on investment and internal rate of return. There's a little bit of equity in this deal, and the comps are in our deal check pro forma, which you can request a copy of. About $10,000 equity out of the chute. So quite rare is you see an immediate jump on return on investment in year one, and then it's just like gets crazy from there. I mean, I feel weird saying it, and we're only putting 3% income, 3% expense growth in there, which is pretty responsible for Birmingham. But if you just set this thing forward and let it do its thing, it's going to be a really good investment for you. Something I do on these properties like this, I like to just hoard that cash flow for a while. Either go into the deal with $2,500, $3,000 just in reserves in case something funky happens. It can happen. Or just don't spend your cash flow for a while, and then you've got that buildup of cash to handle any maintenance that comes down the line, even though it's been renovated. So, Levi, anything you want to add? And I could tell the investors that there are pictures too of the unit towards the end of the deal check pro forma.
Yeah, I just think when you look at the sales analysis portion of the pro forma, and you go out there and look at year, 4, you're looking at a return after sale expenses of 36,800. That jumps up in year 5 to over 84,000. And what's really exciting, I'm sorry, that year 5 number, the second number that is the year 10 number, 84,241. So that's in that medium hold range, right? If you go clear out to 20 years, you can anticipate, $224-ish thousand in return after your expenses. So this is the kind of thing that it makes sense to put that money in and like you said, just let it bake.
Right. I think, we've done some videos on this, Levi, about how real estate investing is ideal, IDEAL. It pays you multiple ways. And we all love that cash flow, which this deal certainly delivers. But when you look at over time, what happens to the investment, you get the income, the depreciation, the equity, the appreciation, and the leverage, especially because we've got that forward rate commitment. You're borrowing money for a cheaper price than what the market will loan it to you right now. And if that number in the market changes, refi, right? So, okay. Well, everybody, that is 16th Court Circle in Center Point, Alabama. Be sure to reach out to us. Levi, what's the email? I messed that up last time. I don't trust myself to say it.
Reach out to us at realestateadvisors@thepeak.group. realestateadvisors@thepeak.group.
Excellent. Thank you, Levi. We'll see you next time.